Facebook, or now as it is called Meta, has an insane investment potential. It has crashed by 75% from its peak. Mark Zuckerberg has lost $100 billion of net worth, but this could have opened an incredible opportunity for us investors. As I intend to profit from the current stock price of the company, in this video I'll analyze in depth the company, its risks and perspectives. Stay until the end as I'll show you a way in which you can see the exact future return per year Meta could offer us, the investors. The analysis is done through the lens of value investing, the best investing strategy out there practiced by the greatest investors in the world. People like Warren Buffett, Peter Lynch, Bill Ackman, and most other great investors in history. As always, all is said with educational purposes and is not meant as financial advice. Before I show you what exact return we can get, we must analyze the exact business of Meta. Its growth or lack of growth, then we'll make a fundamental analysis and at the end we'll do a valuation on the company. The reason Meta has fallen so much is due to the fact investors do not share the same beliefs as Mark Zuckerberg about the future of the metaverse. Over the last 2 years or so, and especially over the last 1 year, ever since Facebook changed its name to Meta, the company has skyrocketed their expenses and investments going to building their future metaverse project. According to the CFO of Meta during their Q3 report, which came out on the 26th of October, the company will invest $85 to $87 billion in 2022. The majority of these investments are going to this new idea of a virtual reality. In 2023, these investments will ramp up between 96 to 101 billion. Since investors do not believe in this new project, they look at these investments as a total waste and burning of capital. This has drastically lowered the earnings power of Meta, and every business is worth the present value of future cash flows. As the cash flows and earnings drop today, so does the stock price. But the current fall is just too much for what the company offers as an investment. In Q3 of 2022, the company had 4.4 billion of net income, which is a drop of 52% compared to Q3 of 2021, when the net income was 9.2 billion. The revenue also dropped on a yearly basis by 4%, and on the next chart we can see that this is the worst growth rate in the company's history. This of course is due to several things, and the major reason is the current lower advertising needs due to the hard macroeconomic factors. Over the last 1 year, a lot of financial institutions, insurers, crypto firms and others alike have stopped or drastically lowered their ad expenses. Also, all other businesses are lowering their ad spend as inflation erodes the purchasing power of consumers and they become more conservative. Another reason for the slower growth is the emergence of TikTok as a new player in the ad space, which sucks advertising capital from both Meta and Google. But let's look at the most important factor when it comes to Meta the company. Are they losing customers? On the next chart we can see the state of the monthly active users of Meta. The company in Q3 of 2022 reported they had 3.71 billion people using their platforms, which is up by 4% on a yearly basis. Here it is important for us to understand to what extent the company can grow. On the next chart taken from Statista, we can see the total global internet users are 5.03 billion, from which 4.7 billion use social media, and a substantial amount of people are from China, where Meta's platforms are totally blocked. This means that Meta's customers are almost all of the people on the planet who use social media. This gives them incredible power and a very strong moat. The term moat was coined by the great Warren Buffett, and it means that the company has an enormous competitive advantage, which gives it security in the sense that over the next 5 to 10 years it's almost invincible when it comes to competitor risks. When it comes to daily active users, the company is again growing with a 4% year-over-year growth rate, going from 2.81 billion to 2.93 billion, or in other words, the daily active users are up by 120 million. For a more in-depth look, we can examine this next chart, which shows the geographic growth or lack of such. The only drop is seen in Europe, while the main driver of user growth is stemming from Asia Pacific and the rest of the world, excluding the US and Canada markets, where growth is pretty much stagnant. Next, we must know what is the average revenue per user which Meta can extract from its customers. The world average revenue on a global basis per user is $9.41, which is a drop of around 6%. Pause the video if you want to examine in more detail each geographical market. Over time, the revenue per user should grow due to the fact that still most businesses do not use Meta as their main source of marketing. The online ad world is much better compared to TV ads, billboard ads, newspaper ads, and others alike due to the fact that everything could be tracked and the return on ad spend, or ROAS for short, can be very precisely defined. Let's now make our fundamental analysis. First, we start off with the debts of the company, as the debts are the main risk for each business, especially in an environment with rising interest rates and massive government and corporate debt levels. The total liabilities of Meta are 54 billion as of Q3. This includes both short and long-term debts. At the same time, the company has 178 billion of total assets. This gives them an equity of 124 billion. When we examine the debt-to-equity ratio, we must divide the total liabilities by the equity, and when we do so, we get a number of 0.44. Here, some analysts like to use only the long-term debts instead of the total debts, which for Meta are 9.9 billion. This would give us a ratio of only 0.08. But I like to be more conservative and I use the total debts. Anything below 0.5 is considered a very stable and a very secure level. So from a debt perspective, Meta is looking great. It is also important to note that only the cash and cash equivalents of Meta are equal to about $42 billion, which is a gargantuan amount. In order for a business to be a good investment over the long term, it needs to be efficient. The best way, according to Warren Buffett and Charlie Munger, is to examine the efficiency of a company by looking at their return on invested capital and the return on equity, and these are 15.01% and 14.07%, according to data stemming from GuruFocus. Anything above a 12% return is considered a very good level. Last but not least, we must analyze whether the company is over or undervalued in relation to its earnings. For this, we use the PE ratio, which currently stands at 9.34, but this could be misleading due to the fact that these earnings are trailing, which means they are for the last 12 months. And we as investors do not invest in the past performance, we invest in the company's future performance. The last 12 months of earnings are 28.78 billion. The great investors always say to be more conservative, as this gives us a bigger margin of safety. I will assume that Meta's earnings for the next 12 months will be the same as this quarter's results of 4.4 billion times 4. This gives us 17.6 billion of potential future 12-month earnings. The current market capitalization of Meta is 263 billion. From this, I will subtract the cash and cash equivalents of 42 billion and we get a market cap of 221 billion. I subtract the cash position due to the fact we're getting this for free. For example, if I have a company and I want to sell it for $100 and someone pays me $100, but in the company's bank account there are $50 worth of deposits, then the person who bought my company actually paid only $50 for the business. 221 billion divided by 17.6 gives us a so-called forward PE ratio of 12.55, which means that in 12.55 years we can get our money back if the earnings stay the same. This is a 7.96% earnings yield per year. In my opinion, the company can easily grow its earnings over the next 5 to 10 years by 3 to 5%, and I'm being quite conservative with these assumptions. This growth in earnings goes on top of our earnings yield, and this means our future potential return from Meta could be in the range of 11 to 13%. And if we have a lost decade for the S&P 500 index, as many investors like Ray Dalio, Jeremy Grantham, and many others think, where there are no positive returns from the general stock market, then such a return from Meta would put us in the top echelon of investors worldwide. As a conclusion, Meta has very low debt levels, very high business efficiency, and a very low valuation, which makes it one of the most attractive buys currently, and the lower the price goes today, the higher our future returns will be. Subscribe to our channel if you would like to see similar content, and comment down below which companies do you want me to analyze next. Hit the bell icon to make sure you don't miss out any of our future videos. Goodbye for now, and until next time.